By far the most frequent question we've had for the past few weeks is it time to buy bonds again? And what can a falling bond market, an increase in bond yields, what kind of risks does that pose, if any, to the equity market? And so I want to just take a couple of minutes to kind of refresh on this. It's sort of a part two on this. We did a video on why bond yields matter to stocks several years ago. So I want to follow up on this. So let's go right into the charts. And what we're looking at here is, in orange is the S&P 500, in blue is just the bond price of the longer end of the yield curve. It's an ETF called TLT, or the ticker symbol is TLT, and it represents the longer end of the yield curve, 20 years and longer in terms of maturity on bonds. And as you can see, we have this divergence here where stocks, for the most part, continue to march higher. Bond prices have fallen quite sharply, which means basically bond yields have risen. And so a lot of people associate this with higher borrowing costs, and I think that's a bad thing for companies, and that is entirely possible at some point down the line, although this divergence, quite frankly, can continue for longer than a lot of people think. We're currently in the camp here in early 2021 that bond yields could, over time, over the ensuing few months, still go higher on the longer end of the 10-year sort of mark in the on the belly of the yield curve, 5 to 10 year, kind of that area. But I think another way to think about it, and a lot of people don't really register that on the retail side, on the institutional side, this is a common practice, is to discount your cash flows when you do an analysis of a company's futures cash flows. And if the discount rate goes up, you are coming out with a lower present value. So the higher the interest rate, the discounting rate, the lower your present value of those cash flows, because you have a higher interest rate. And so when you do that, the multiple that a stock might trade at, or again the present value, is actually lower. Now, so this is why maybe you guys have seen this before in the past few weeks or so. People are talking about this being a risk to the stock market. Not that it has to fall apart, but I think what this rise in yield is doing, it's going to dramatically dampen the acceleration, the rate of change of the broader headline indices like the S&P 500, at which they can go higher. It's also going to cause more divergence within the equity market. So our big call here for 2021, dare I say, and look forward, is that we are going to see somewhat a bursting in the passive investing bubble. And what that means is we're going to see a sort of an alpha generation methodology, a more proactive investing ideology, where you're not just buying an index and letting it sit, but you're really looking for the opportunities where with the advent of somewhat higher interest rates, things do get more challenging for the average investor, and so a more proactive approach is important. So that's as much as why bond yields are important to the stock market. If we flip to the chart here, and again, right now what we have here on the chart displayed is the S&P 500 in orange, and again, bond price is essentially down here. Now, instead of doing too much on the bond yield side and trying to maybe buy bonds again, which I think is too early, one thing that we do think makes a lot of sense is, and watch the blue line down here, I'm going to change it to a different chart, is to buy something like an ETF that is more in a bottoming phase. And here we're looking at commodity prices. And if you look at commodity prices versus stocks, versus the S&P 500, you can see stocks have gone vertical, but commodities really haven't done anything. They've just basically based for the past 5 to 6 years. And we think there's a big catch-up rally, potentially a mean reversion move where equities, at least the headline indices, stop going higher at the rate of change which they have, and commodities start to catch up, which, by the way, also is that's why I'm mentioning it, sort of an alternate way, or maybe a better way, dare I say, to play this rise in yield. So I'm going to get rid of the S&P chart here and just show you the chart of DJP. Again, this is just an ETF that represents commodity prices. You can kind of draw your own lines and figure out the technical juncture here, but I do think we're at a point where commodities have a brighter future than a headline equity index for the next 12, 24, maybe 36 plus months. So if you are concerned about higher yields, maybe this is an opportunity to pare back on some of your equity index longs. If you long the S&P 500 in size in your 401ks, maybe it's time to clip that somewhat. It's not a recommendation, just an idea based on our research. Figure out if that fits your portfolio, and maybe replace that with being long some commodities. Now, commodities have already had a pretty big run here in the short term, but if you look at the long-term cycle, and if we do expect more inflation ahead and higher interest rates, commodities do make sense to be long here as sort of an asset allocation shift in your longer-term asset models. And from a trend following perspective, I would argue that commodities are going to be an easier trend following move to the upside than say the S&P 500s of the world. So I hope this helps, folks. Give us a thumbs up, like, and we'll see you soon.